The total tax revenue generated by the imposition of a tax, the incidence of the tax, and the excess burden of the tax, or what's also known as the deadweight loss due to a tax, all depend to a very large extent on the elasticities of demand and supply. In particular, when we're thinking about the tax incidence, that is, the amount of the tax paid by the buyers on one hand and the sellers on the other, irrespective of who it's actually levied on officially, depends heavily on this elasticity. So if the demand curve is relatively more inelastic than the supply curve, then the buyer will pay a larger share of the tax, irrespective of who the tax is levied on. On the other hand, if the supply curve is relatively more inelastic than the demand curve, then the seller will pay a larger share of the tax. When we talk about larger share here, the terminology we use is the tax incidence. And we can see this diagrammatically. So let's say we're talking about labour income. We'll impose a tax on labour income, whether it's wages or salaries. That's not so important. Let's say that the demand for labour is relatively wage elastic. That is, a change in the wage will have a relatively large effect on the quantity of labour demanded by employers. And let's further say that the supply of labour is relatively wage inelastic. That is, a change in the wage rate will have a relatively small effect, proportionally smaller effect, on the quantity of labour supplied, offered in the market by workers. When this is the case, we can see, and we will see, that the incidence of tax, the tax burden, falls predominantly on the workers. So here's our supply curve for labour and our demand curve for labour. The demand curve for labour, this is the employer's demand curve, and this is the worker's supply curve. We've got our equilibrium price and quantity, and everything's going along hunky-dory. And then let's say a tax is imposed on workers' salaries or wages. Now we know that the imposition of a tax on the suppliers will shift the supply curve upwards. So we can see there. And so we're going to take that tax that's been imposed, and that's it here, and we're going to wedge it back in here. Wedge it in between the two original demand and supply curves. And as a result of that, we can see we'll shift to a new equilibrium wage here of $20 that is paid by the employers, and the wage after tax that workers actually receive. It's the after-tax salary or wage rate, $16. Now we know of this tax that's been imposed, some of it is going to be paid by the employers in the form of having to pay higher wages. That's this here. $1 per unit of labour paid by the employers. But the remainder of the tax is going to be paid by the workers. So we can see in this case, when we've got a demand curve which is relatively flat or relatively elastic, and supply curves which are relatively inelastic, that when the tax on workers' income is imposed, the burden of that tax falls predominantly on the workers. And we can also see there, thanks to our welfare analysis, that a dead weight loss has been created. So we've gone from 40 units of labour employed down to 35. So, so some of the employer surplus is lost and some of the worker surplus is lost. The total lost area, the dead weight loss, is that triangle there, that grey triangle. So we can say the imposition of the tax on workers has resulted in a dead weight loss of economic welfare. It's inefficient in this perfectly competitive labour market. Well, what if we instead imposed a tax on employers? So in this case, that would be a payroll tax. So this is a tax that's imposed on the employers based on the wages that they pay the workers. As before, let's say that the demand for labour is relatively elastic and the supply of labour is relatively inelastic. In this case, again, because of the elasticities, the incidence of the tax, this payroll tax, will mainly fall on the workers, despite the fact that it's actually been officially imposed on the employers. So again, we've got our demand-supply curves, a relatively flat demand curve, relatively elastic, and a relatively inelastic supply curve. And we're going to impose a tax on the employers, that it will affect their demand for labour. There's our tax. We're going to wedge it in to here. So it pushes the labour demand curve downwards. The employers are willing and able to employ workers only at lower wages. And we can see there that what's happened is that we've now got a new equilibrium due to the new lower demand curve with the imposition of the tax. And the workers receive the wage of $20 with 3,000 workers employed. And the employers will have to pay, after tax, $25. Because it's the $20 plus the tax imposed on top that they will have to pay. We can see from here, when we look at this tax that's imposed, how much of that tax is paid by the employers. The original equilibrium was $24. Now the employers have to pay $25 per worker. So that's $1 per unit paid by the employers. What about the tax that's in the part of the tax that's imposed on the workers? Well, they were originally getting $24, but now after the tax has been imposed, they're actually receiving $20. So that's $4 of the tax per unit of labour that is paid by the workers. So we can see again that the tax predominantly falls on the workers. The government collects this much in tax revenue, and we can see that that triangle there, originally 4,000 workers were employed, now it's 3,000. So some of the economic welfare area has been lost. That triangle there represents the dead weight loss of economic welfare. What about the extreme cases, however? Here we start to get slightly interesting, well, before what we saw wasn't interesting, we start to see interesting results here. When demand or supply is perfectly elastic, that is, the demand curve is horizontal or the supply curve is horizontal, then the imposition of a tax will generate a dead weight loss of economic welfare, and therefore the tax will be inefficient. But, interestingly, when the demand or the supply curve is perfectly inelastic, that is, the demand-supply curve or supply curve is a vertical, then the imposition of a tax will not generate any deadweight loss of economic welfare. And in that case, the tax would be allocatively efficient. It wouldn't result in a deadweight loss, so it would still, even with the imposition of the tax, you would still get an allocatively efficient outcome. So let's look at an example. Let's say that capital is internationally mobile. So the supply is perfectly elastic. Thanks to technological and legal innovations, we can say that it's close to perfectly elastic at least. Now in that case, with a downward sloping demand for labour and a horizontal, perfectly flat, perfectly elastic supply curve for capital, then here we're talking about capital, not labour, then we can say that the incidence of the capital tax will fall entirely on the firms who are attempting to buy capital. You can see it graphically here. Here's our supply curve for capital. K stands for capital here. And we've got our capital demand for capital here. This is the demand on the part of firms. In equilibrium, we've got 40 units of capital stock purchased at the interest rate of $6. Let's say a tax is imposed on the sellers of capital, the suppliers, which pushes their supply curve upwards. Now, in that case, we'll then have to move to a new equilibrium, where the capital stock bought and sold will be 20, but now at an interest rate of 10%. Now that entire increase in interest rate, that entire increase in the price of capital, is being paid by whom? It's being paid by the demanders of capital, that is, the firms. So the entire incidence of the tax falls on the buyers of the capital. But we can see there that there will be an allocatively efficient, it's allocatively efficient because we know that a deadweight loss will have been generated. We were producing, buying and selling at 40, now at 20. So this part of the demanders or the buyers' welfare has been lost. And that's entirely deadweight loss that comes from the buyer's surplus, that is the firm's surplus. What about an absolute necessity? So in the case of an absolute necessity here, we're talking about the demand for a product which is perfectly inelastic in price. That is, it doesn't matter whatever the price is, there's the same quantity that's going to be demanded. So the example here would be a life-saving drug. In that case, we'd say that if a sales tax is imposed on this life-saving drug, which pushes up its price, that tax will be entirely paid by the purchasers. But there'll be no deadweight loss of economic welfare. So we can say it's allocatively efficient. Here's our graph. Here's our supply curve for the life-saving drug. And here is the demand for the life-saving drug. It's vertical, indicating that the buyers of the life-saving drug are willing to pay any price for a fixed quantity of 100 doses. So if we imposed a sales tax which pushes the supply curve upwards, sales tax of 20 cents in this case, pushes the supply curve upwards, the price increase is exactly the same as the tax. That price increase is paid by the consumers, so the entire tax is paid by the consumers. But is there any deadweight loss in this case? Well, as you can see there, no, there's no deadweight loss. The quantity originally purchased was 100, and the quantity now purchased after the tax is still 100. So there's been no deadweight loss generated. So we can still say it's allocatively efficient. This doesn't necessarily mean that it's morally right, but it is allocatively efficient. What about the case of fixed supply? That is where we would have a supply curve which is vertical. That is, no matter what the price is, the quantity supplied will remain constant. An example here is easily accessible and unimproved land. In this case, the incidence, if a tax is a resource tax, for example, is imposed on the sellers of the original owners of the resource that's in fixed supply, that tax will be entirely paid by the resource owners. None of the tax will be paid by the buyers of the resource. So this creates no deadweight loss, and again, therefore, is allocatively efficient. So here's our downward sloping demand curve for land, and let's say we've got a fixed supply of land. There's our equilibrium. And let's say we impose a tax on the owners of the land, the suppliers of the land. Well, that tax doesn't shift the demand curve in any way because it's imposed on the suppliers. Now, if we impose that tax, does it shift the supply curve upwards? Well, even if notionally it shifts the supply curve upwards, it's not really a meaningful thing to say because it's a vertical supply curve. Rather, what we would say is that the price remains at 1,000, but the owners of the land will have to pay from that 1,000 the amount of the tax imposed, leaving them with $600 in, say, rent after that. Again, can we see any deadweight loss being created here? No, we know there's no deadweight loss because the original quantity produced was 250 and the new quantity produced after the tax has been imposed, which has extracted some of the rent from the landowners, the quantity supplied and sold is still the same. There's no deadweight loss generated. It's still an efficient outcome. So in this case, we can say the tax is an allocatively efficient tax. The same arguably applies to the owners of unique assets. If their supply of the asset is fixed and independent of the price or payment that they receive for that asset. So, for example, we might take the case of film, music, or sports superstars. It's at least conceivable that they would be willing to supply their services at a fixed quantity of their services at whatever price. In which case we could say, let's say we'll take the example of Russell Crowe. We've got the demand for Russell Crowe services from film studios, and we've got the supply of Russell Crowe services. And what we're assuming here is that Russell Crowe is willing and able to supply his labour for 3 movies per year, no matter what the fee he receives, whether it's 20 million, 30 million, 12 million, he's going to make 3 movies per year. Now, if that's true, and we impose a tax on Russell Crowe, then it doesn't change the demand in any way, and it doesn't shift the supply curve to to the left or to the right. Remembering the tax would be shifting the supply curve vertically up or down. But in this case, since it's a vertical curve, it doesn't make any sense to say it's shifting up or down. So Russell Crowe, the equilibrium fee is still $20, which he receives, but after he's paid his tax, 40%, he's only receiving $12 million instead of the 20. But we can see there that even at $12 million, he's still willing and able to make supply services for 3 movies. So we can say, due to his inflexible or perfectly inelastic supply curve, we can impose a tax on Russell, and it will not result in any deadweight loss, despite the fact the entire burden of the tax is being imposed on him.